Should investors be concerned about the Hindenburg Omen? Apple adds $200 billion in market cap on their AI news, and PIMCO warns of more regional bank failures. These topics and the team's take on the May CPI report on this episode of Investment Insights from Opal. Our first topic this week is about the Hindenburg Omen. Adam, what's your take?
Well, first of all, just in case someone doesn't know what the Hindenburg Omen is, it's not a CIA movie starring Chris Pine that does poorly at the box office. It's a stock market indicator, and it's based on a couple criteria. The market needs to be in an uptrend, and you need to have on the same day 2.5% of the companies in the index need to make a 52% high, and 2.5% or more need to make a 52-week low. So it's basically about it's almost an indicator of a barbell effect in the stock market, and it predicted the 2008 global financial crisis. I think it predicted the COVID crash. It has predicted 20 out of the last 2 market crashes. It's very effective. Now, look, in all seriousness, it's interesting to see some of these indicators when they flash, because it makes you stop and think and really assess your view of where you think the market could go in the near term. But like any single indicator, don't panic. It triggers way more often than the stock market actually crashes. And really, to me, it's just a signal of what we've seen in the market over the last couple of years, where you've got the big winners driving the index, and a lot of other sectors, companies that have just fallen out of favor. Austin, what's your take?
Yeah, I think it's actually kind of surprising to me that people are just talking about this Hindenburg indicator now, because as Adam referenced, it seems like the market's been in this pattern for some time. As you know, everyone gets all excited about a handful of names at the top of the market, and there are a lot of names that are down at or near 52-week lows. It creates a lot of opportunity for active managers, especially if there comes a time, kind of like in 2022, when the names at the top of the market don't do as well, and some of those laggards have a chance to catch up a little bit.
Yeah, I feel like I've heard about the Hindenburg Omen off and on my whole career, and it, like Adam said, this predicted 20 of the last 2 recessions.
But a great name, right? A great name for an indicator. There's no doubt that I'm 100% on board. Great name.
And it makes for great graphics, like our editor's putting on the screen right now. Scary.
Yeah, and any investor under the age of 60 has to Google what the Hindenburg was to get it, which is also fantastic.
Next topic, Apple had a big day yesterday on their AI news. Austin, what's your take?
I think it's interesting because everything that I've heard doesn't really indicate how Apple is going to monetize this new AI on the device. It does seem like they're just kind of playing catch up. And with that kind of catch up, the question from me is there going to be any incremental revenue from partnering with OpenAI, or is it just going to be kind of trying to maintain their current market share? The market seems to be saying that there's going to be incremental revenue, but the evidence is maybe slightly different right now, at least in my mind.
Adam, what's your thoughts?
Yeah, I'd have a slightly different take on it. Look, I think Apple has a history of not being first to do something, but taking the idea and sort of commercializing it for the regular people, so to speak. And putting an AI on iPhones is a very interesting idea. And I think the market reaction suggests that the people think that this is going to lead to some sort of ridiculously robust, iPhone replacement cycle where everyone that has an old iPhone is going to upgrade so they can use this AI functionality, which might be great for a year or two, but then will create a hole in the future. But look, Apple, if revenue can grow mid-single digits and net income can grow high single digits, low double digits, and then you throw on some share repurchases along the way, can Apple's EPS over the next 2 to 3 years now grow 12, 15%? Maybe. Does that justify a 30+ multiple? Also, Apple put on over $200 billion of market cap yesterday just on this news, right? And it's up again today, 3 or 4% last time I looked. Apple's increase in market cap yesterday and today, just that market cap increase would be a top 50 S&P 500 company. just to put in perspective how much this move is. That seems a little much.
Also, yesterday, Elon Musk brought up some concerns about having that technology on a phone. Does that play into the calculus here on the valuation?
Well, I think Elon threatened that anyone that worked for one of his companies wouldn't be allowed to bring an iPhone into the building, which is great for headlines. And I think he might have walked it back already. I'm not entirely sure, but I think he was just, he just wanted to use the Apple news as an opportunity to get his name and his companies in the headlines again. That was my take.
Austin, any thoughts on that?
Not really detailed thoughts. I think at the end of the day, Apple, like, you could say it's a software company, you could say it's a hardware company. They still get a significant portion of the revenue from hardware. A refresh, so a customer that replaces an old iPhone with a new iPhone, it's not clear to me that that's extremely good or bad for the software business. So the question for me continues to be, how do you monetize this? Like, how do you monetize AI? It doesn't seem like the market cares today. But at the end of the day, for, I think, serious investors who want to invest in the space and capitalize on the movement, you need to really think about where the cash is going. And I don't necessarily see this announcement driving a lot of incremental new cash to the company. So I do think that, whether it be 200 or $300 billion, it seems like it's a stretch. Creating like as Adam said, a whole new company essentially that's towards the top of the S&P 500. That seems like quite a stretch at this point.
And if I could add one more thought, one thing I haven't heard anyone talk about, and I could be dead wrong on this, but if Apple is adding AI functionality to the iPhone, and right now Google pays Apple to be the default search engine on the Apple browser, so the Apple installed base, you go to search something, it's a Google search. Will Apple Intelligence, I believe that's what they're calling this, will that take over that search functionality? Should Google have been down as much as Apple was up?
Well, or is Google not going to be down because they're not going to have to pay the hundreds of billions of dollars to Apple
And
in
they're
the
not,
future for
yeah.
access
Or is it a
to
wash?
that? Yeah, who
But
knows?
it seems like that would be. It seems to me like, not having run any numbers and going purely on intuition, it seems like that would be a negative for Google if that were to happen. But
it seems like all this is purely being driven on speculation and emotion, which is really hard for, someone who tries to focus on fundamentals to grasp. Not saying that it's wrong. The fundamentals might catch up, or maybe the market is onto something that we are not onto. There are other ways to play the trend. And, there are a lot of players, back to Jay's question, who are trying to do kind of edge compute or AI on device. I'm not a scientist or a computer programmer to know if that's really that bad for the world, or if robots are going to take over because they got a hold of your iPhone that has some AI functionality on it. It seems like Apple is trying to make the argument that the data is going to be private, or there aren't going to be any customer specific data points. But again, I don't really know how that works. You probably have to talk to a programmer with a specialty in AI, and I'd be willing to bet that Elon Musk is not that, but he's trying to make headlines. And, as Adam said, already started walking back some of those comments.
Stepping back from Apple for a bit, and just at the risk of just creating a soundbite, Austin, it doesn't feel like it was that long ago that you and I and some other folks were sitting in a conference room debating having a constructive dialogue on whether or not there was a law of large numbers for the size of companies. And could Apple continue to grow? And this was at a time when there were no companies with a market cap of over $1 trillion. Now there's multiple companies. It's pretty wild what's gone on in the last 5 or so years.
Yeah, and I would just say that just because there's 3 or 4 companies, I mean, you've got $2 trillion market caps now. It's not even $1 trillion. Just because they're currently priced there doesn't mean it's justified, right? And so it gets back to like, how do you create long-term value versus like the short-term emotion in the market, and how much of what we've seen in some of these names is short-term emotion versus long-run value. If this is a justifiable valuation, I think just my intuition says we got a lot of inflation coming for the rest of the world to catch up with these things, right? Because otherwise these few companies are essentially taking over, the world pretty quickly. And if they continue to grow, they're going to kind of consume the entire global financial system.
Let's move on to our next topic. Both of you are alumni of PIMCO. There was an article out recently that said that they are questioning whether we should have concerns around regional banks. Austin, what's your take?
I would take this one with a grain of salt because similar to that Hindenburg Omen, it seems like PIMCO's predicted 20 of the last 2 recessions. So they seem to kind of run around screaming that the sky is falling, and it doesn't always fall. But in this case, there might be some justification. One of the things that we've done at Opal is we've significantly cut back our regional banking exposure, mainly because we saw some of these risks coming. As interest rates started to tick up, there were deposit issues like in the immediate term, but after you go out a few years, call it 2 to 5 years, and some of the commercial real estate lending starts to mature, it puts borrowers in a tough spot. If they had a decent asset where they were paying 2% on their loan, and all of a sudden the pricing on the loan goes up to 7 or 8% because just the base rate has increased, they may not be able to make those payments going forward, and they may not be able to refinance that loan, which then makes these loans on the books of the banks considered bad debt, and then they have to do something with them, whether it's sell them at a significant discount or hold them and hope for the best, or restructure them, taking a lower yield than what they could get on other loans, meaning they technically have to mark them down. All of these scenarios are relatively bad for regional banks. And so there's kind of one of two things that will likely happen going forward. You're going to see a significant slowdown in credit formation going forward as there is less lending coming out of banks due to higher interest rates, or you're going to see the Fed reduce rates, allowing many of these companies to refinance at much lower rates and taking pressure off of the system. The most likely outcome is you're going to see some pressure, and then you're going to see the Fed reduce rates because of the pressure and save the guys who could hold out longer than everyone else. But it's kind of a story we have to wait to see how it plays out.
Adam, any thoughts?
Yeah, I think Austin covered it really well. So I'll just quickly add, I think it was last week, an office building in New York City in a short sale sold at a 67% discount to its previous valuation. So there's a bank or banks that just took a little hit to their capital on that one. And there are a lot more buildings like that. So the real question is, where are rates when they need to refinance? How many banks have how many of those loans on their books? And if those loans were all marked to market, what would that do to their capital? And in the moment, maybe we're okay. But if the Fed wanted to destroy the regional banking system, just increase rates another 25, 50 bips and then wait for the fireworks. But and this is actually a nice segue to the next topic, right? If inflation is going in the right direction, maybe they get bailed out just by the timing of sort of the slowdown in inflation.
Well, Adam, let's jump into that. The May print came out today. The narrative is that inflation is cooling. What's your take?
It's amazing how being 0.1 below what expectations were gets everyone really excited. But the jobs number was hot a week ago. So, maybe this now is a data point that suggested the economy's still ripping and maybe there's no cuts or does the Fed have to raise? What's going on with inflation? And now all of a sudden we get a data point, a week later that sort of suggests kind of the opposite. So I feel like, to me, we're still sort of in this holding pattern where things could go either way. We're not quite sure. We need more data, which is sort of, I sound like a parrot every week saying the same thing. But I'm not as excited as the market algorithms were this morning. But I'm also glad it wasn't going in the wrong direction.
Austin?
Well, I think it's interesting because one of the main issues here is that as more liquidity flows into the system, because the Fed has potentially the opportunity to reduce interest rates. So as the markets go up, more liquidity is flowing in, more people get excited. It actually could lead to more inflation. And so I think that we're going to have to see some hiccup. It's not going to be a really smooth landing where there are no issues with the economy and, we get inflation under control and everyone just kind of like cruises off into the sunset and everyone's happy. I think there's actually going to be some type of event, right? If you don't have an event by the Fed reducing rates and pumping up asset prices, you're just going to stoke inflation and create a problem that you were trying to prevent with higher rates in the first place. So I think people are getting a little too excited in the short term. At the end of the day, when the Fed starts reducing rates, it tends to mean that the stock market's going to go down because there's some type of issue in the economy. We haven't seen an issue to date, but investors should be, on the lookout for issues. And one of those issues could be, a previous topic, the commercial real estate issue that PIMCO is pointing out. But there are a handful of others that could pop up that create problems and kind of push markets lower, even though the Fed's reducing interest rates.
It almost seems like the sweet spot for the stock market is for inflation not to go up, but not to go down, and just to keep us all guessing. If every data point just flip-flops on what expectations are, the market can do just fine. But as soon as it decides as soon as inflation really moves one direction or another, we're in trouble either way.
Yeah, people get excited about things staying the same rather than, moving one way or the other. Because I guess it is kind of a Goldilocks scenario right now, right? Like nothing bad's happening and interest rates are kind of slowly drifting down. It just doesn't seem like that can happen given everything that we know.
Gentlemen, great show this week. Viewers, if you want to ask the team a question, shoot us an email, podcast@opalinvest.com, or scan the QR code on this screen. To learn more about Opal Capital, visit opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.